Hello and welcome to Startup Street. Shruti, Arundhati and I are joining you from the Mumbai studio today. Here are the headlines that we're tracking. New age digital entertainment and technology company Jet Synthesis acquires a majority stake in Kids Byte, an educational news and knowledge media platform for kids. The partnership is aimed at transforming the way children access and engage with content.
Varanium Capital marks the first close of its maiden venture debt fund, which has a target corpus of 250 crore rupees, has a green shoe option of 50 crore rupees as well, firm to back 100 startups in India via revenue-based financing and traditional venture debt.
Record Club launches Regreen Fund to back India's green startups with $10 million. The fund will provide selected firms with access to growth capital without equity dilution. It's going to enable them to scale operations, accelerate product development, and expand market reach.
Smart Staff, a blue-collar staffing platform, gets $6.2 million in a Series A round, gets funds from Nexus Ventures, Arkham Ventures, Bloom Ventures, and Ulterior Capital. New capital will enable the startup to look at new geographies and categories.
PhonePe-backed PIN Code, a shopping app developed on ONDC, goes live in 10 cities across India. Consumers in these cities will be able to purchase groceries and order food from their local shops and restaurants on PIN Code.
Byju is unlikely to renew its endorsement contract with Bollywood actor Shah Rukh Khan when it ends in September, say reports. With the edtech platform in serious trouble, Shah Rukh's team is hesitant to continue association with the brand.
Facebook's parent Meta is all set to take on Twitter with its new conversation app called Threads. The Twitter rival is visible on iOS stores and is expected to be available for downloads after its official launch on the 6th of July.
Those are the headlines we've been tracking for you this evening. Global asset management firm Varanium Capital, that manages close to $1 billion in assets across structured debt, portfolio management services and venture capital fund, today announced the first close of its maiden venture debt fund worth 250 crore rupees. The 7-year-old company plans to provide funding through a mix of revenue-based financing and traditional venture debt to up to 100 early-stage to growth startups in India. To elaborate more, joining me now is Aparajit Bhandarkar, venture capital partner at Varanium Capital, and K.S. Sridhar, former CRO, IndusInd Bank and advisory board member at Varanium Capital. Gentlemen, welcome to Startup Street. Aparajit, let me start with you. First, tell us the reason behind launching a debt fund. What pain point are you looking to solve? And if you could also talk about the offerings for the 100 early stage to growth startups that you plan to invest in, what will be the average investment size?
So thanks, Shruti, for this. So one of the reasons for considering this was, the first part is that if you look at America, typically about 15% of the venture capital funding equivalent to that comes from venture debt. In India, that number till last year was less than 3%. This year, it's slightly higher at around 3%. So there is a lot of headroom for India to do a little bit more of debt funding for startups. The second thing was, in terms of pain point, we found that given the slowdown in startup funding, and also that there were a lot of startups which are making good revenues and consistent revenues with good margins, we found that there was an opportunity to finance them with debt. And so we were thinking of this product since last year. The average ticket sizes that we would be funding typically are in the range for, there are two categories. One is called revenue-based financing, which is for startups which typically make between 30 lakhs to about 3 crore of revenue a month. Typically here we will finance between 30 lakhs or 50 lakhs to about 3 crores, average ticket size of about 1 crore. And some of the startups which are larger and have graduated from this would typically end up being financed between 5 crore to about 15 crores, average ticket size of 7 to 8 crores.
All right. Aparajit, also tell us what sectors are you looking to invest in and how soon, and if you've already deployed some capital.
So, Shruti, in terms of sectors, we are sector agnostic. But some of the sectors that we like include D2C, which is direct to consumer, which is seeing a lot of growth in the last few years. It's seen an increase in funding from about $100 million in 2018 to about $1.36 billion in 2022. So about a 14x growth in terms of funding to that sector. So that's one sector we like. We like the SaaS sector because people are making consistent revenues.
Yes.
Besides that, B2B enterprise startups, and we might do some in terms of fintech, which has been our first fund, so we do understand some of those areas as well.
Okay.
And in terms of your second part of the question was, have we deployed capital? So far, no. We typically wait for the first close. We will start deploying in the next 2 to 3 weeks. However, we've been able to see a good set of deals because we've, in our first fund, invested in GetVantage, which is a revenue-based platform, and I've been a director on GetVantage. So we've seen some of this in the last 1 year.
All right, Aprajit, so you're looking to start investing in the next 2 to 3 weeks. Sridhar, let me quickly come to you now. While you plan to empower early and growth stage startups, tell us, how do you plan to identify suitable investment opportunities for your debt fund? Also tell us, how would you underwrite and monitor potential debt investments to safeguard credit losses?
Yeah, thanks, Shruti, for this. As Aprajit mentioned, we have certain sectors which we are going to target. In terms of how we zero in on these clients, we are going to have both an internal team, a deal origination team, as well as partnerships with a couple of agencies which we have looked at. And as we go forward, we will have more such partnerships on the anvil. So we have a few laid down parameters in terms of what kind of clients will qualify for our lending programs. In terms of underwriting, we have a three-pronged strategy. We are going to use the classical credit models in terms of risk management, assessment, etc. We are also looking at some metrics which are very, very tuned towards the startup universe. So these are not things which we, in the normal process, use in an NBFC or in a bank lending. Okay. And finally, we intend to use a whole host of technology tools, such as machine learning and algorithmic-based credit scoring, etc., which will enable us to do a faster credit underwriting, and maybe with lesser human involvement as well.
Okay. All right, Aprajit, coming back to you, Sridhar spoke about assessing the credit worthiness and the profile of potential borrowers. Can you now throw light on the rising interest in venture debt financing? Reports suggest that debt funding accounted for 4.81% of the total $5.4 billion raised by Indian startups in the first 6 months of 2023. And this is a big jump over 1.48% of the total $6 billion raised by startups in H2 of 2022.
So, Shruti, you are referring to the report which has been recently published by Inc. 42, and it's very informative. So what's happened is that one part is that the startup funding from the equity side has declined a bit over the last 1 year, given a little bit of the funding winter. The second part is that a lot of startups have moved toward profitability. And because they have moved towards profitability, there is a potential to finance them using a little bit of debt. So that is the second reason which is driving it. And the third reason was actually that, as I had earlier mentioned, that the penetration of venture debt in India was much lower than what it was in the Western markets. So we spotted this opportunity a year ago, and we've been envisaging launching this fund for over a year, and we've been seeing some of the patterns of these startups which had got very good revenues and very good track record in terms of payment record. So that's something that we've been tracking, and we wanted to look at it for more than a year. So Mr. Sridhar and the team and us discussed this for more than a year before we've launched this.
All right. We've completely run out of time, but Aprajit and Mr. Sridhar, many thanks for joining us on Startup Street today, and wish you the very best with this maiden venture debt fund. Thank you so much for joining us.
Thanks, Shruti.
Well, on that note, we're going to move to another CNBC-TV18 exclusive then. B2B insurtech startup Plum is set to foray into business insurance with 6 new products. Now, this is the third line of business that Plum has launched after employee insurance and employee health benefits, and it also aims to turn profitable by FY25. Now, the Tiger Global and Sequoia-backed technology platform provides health insurance benefits to corporations and currently works with more than 3,000 of them, of which about half are startups. So joining me now to talk about this new business plan and the company's ambition to turn profitable very soon is its co-founder and CEO, Abhishek Poddar. Abhishek, welcome to Startup Street. Thank you for your time here. It's quite the shift for you at Plum, from the core of employee insurance, employee benefit, to now business insurance. Tell us the rationale.
Hey, first of all, thank you so much for having me on the show today. It's great to be back. So if you think about it, the financial well-being of a business is directly proportional to the financial well-being of its employees. Today, if you look at businesses, they're prone to various risks, be it financial risk, operational risk, legal, people, governance related. And more so today, if you pick up your newspaper, every day you will read at least one or more news about some financial litigation on an organization, be it a startup or a larger organization. But what has happened, unfortunately, is most of these business risks remain uninsured for smaller organizations and especially the startups. It has been largely restricted to the larger organizations that have set up business insurance. So with Plum business that we are launching, this is our third line of business. Our goal is to create a sustainable ecosystem that safeguards all kinds of risk for the businesses. When we started Plum, we looked at the employee side of the risk, the employee health and benefits, but we saw this as a natural extension for the same customers that we are serving. You talked about the 3,000 customers that we are serving. This is a natural extension for us from a product line perspective, where our customers have been asking us, how do we protect our businesses from all angles?
No doubt that they're very closely linked, of course. But, if you could put into numbers what the size of the opportunity in this new business line is for you. And, what's the kind of market share you're hoping to capture, given that, it's a crowded space?
Yeah, so let me first zoom out in terms of the market opportunity. If you look at the current market is largely restricted to very large organizations setting up business insurance. And when we think of business insurance, think of director and officers insurance or a general liability insurance. These products have been restricted to very large businesses. So I would look at the market as mostly untapped market. The current market would be in tens of thousands of crores, but the real market opportunity is, in my sense, it's at least 10x of where it is right now. And what we are going after is actually expanding the market rather than going and competing with existing players who have been serving the very large organizations. Our goal is to essentially, one, build awareness about these products to the smaller organization who do not protect themselves, and number
Abhishek,
two, make these products accessible.
That's an easy answer. We're not going to let you get away with it, because when you talk about a country like India with 1.4 billion people, obviously the opportunity is large, and there's always scope to expand the pie, especially when you talk about finance and insurance, significantly underpenetrated. But what are you doing differently? And you say this new line is going to help you turn profitable as well by FY25.
Yeah, so what we are doing differently is, one, we have simplified the product for the smaller organizations. We have created purchase flows and user journeys where now startups can set up these insurance in matters of minutes. These products were earlier not even accessible to smaller organizations. So imagine an organization that you have set up maybe like 10 days ago. Those kind of organizations were never provided this insurance before. So we have made this insurance accessible. We have made it really easy for organizations to purchase this insurance and then use this insurance. In terms of how this is going to help us in terms of both growth and profitability. So from a growth perspective, when we launch any new business line, our very simple philosophy is that new product should be as large, if not larger, than our existing business lines. So this is our third large business that we are launching. Our goal is that in the next 2 years or so, this should be at least 1/3 of our business, which, if I have to put it in an absolute number, should contribute to at least 50 to 100 crores in terms of revenues in the next couple of years. Okay. From a profitability perspective, so just to give you context, we as an organization have already turned contribution margin positive. Our goal is, how do we turn this organization now into an EBITDA positive organization and generate free cash flow? We have taken a target of next 12 months to do so. And this is essentially giving us that additional revenue growth. Right now, we are growing at almost 3x year on year. So this is giving us an additional push on the revenue growth to turn profitable in the next 12 months.
But, Abhishek, it's not been an easy time here at Plum as well, right? And you had to let go of almost 10% of your employees last year amidst what you said was a very difficult environment. Is the situation getting better now? Is the outlook for insurance tech improving?
Yeah, so I think the decision that we took almost 6-7 months ago was in light of the macro environment that was happening. I think we expected the market to grow faster and Plum to grow faster at that rate. we had forecasted almost a 5x, 6x growth, but we grew by 3x. If you look at it in an absolute terms, 3x growth in itself is huge, but we over-anticipated the growth and we overhired at that point in time. And that was a course correction that we did almost 6 months ago. But from that point onwards, we looked at a 10% number, but the absolute number was we had let go of around 30 colleagues of ours. We have grown significantly after that. In last month itself, we would have hired more than 30 people. So we as an organization are growing a lot recently, and we continue to grow. We continue to scale our organization as well.
Okay, you let go of 30, but then you hired 70 people. Abhishek, we're completely out of time. Just a quick question, if you could answer in a few seconds. Your target is to ensure 10 million lives, right? And you're currently at 0.5 million, 5 lakh. That's a significant jump you're looking at in just the next 2 years. How do you plan to go about it?
Yeah, I think if our goal is very simple, which is if we continue this path of 3x growth, I think it will take us another 2.5, 3 years to reach that 10 million number. In the larger scheme of things, I think it's the more important thing is the scale of impact that we make, which is the 10 million lives. So we may reach there not in 2 years, it may be 3 years, but we have our minds set on that 10 million number.
Okay, the 10 million is the target, not the time frame to achieve it. Abhishek, thanks very much for speaking to us here, and we look forward to speaking again, perhaps in better times.
Hey, thank you so much, Ritu.
On that note, it is time for us to head into a short break. But coming up next, Flipkart-owned Cleartrip completes 70 years since it launched its operations. We put the company's CEO on the hot seat to find out more. Welcome back. You're still with us on Startup Street. Flipkart-owned Cleartrip has cemented its position as the second largest OTA player in the country. This, according to a recent report. The report added that Cleartrip saw industry-leading growth in FY23 and strengthened its position in the segment. As the firm completes 17 years since it launched its operations, we put Cleartrip's CEO on the hot seat to find out more about their road to profitability, the next leg of growth, and their big bets for this year. Ayapan, thank you so much for joining us on the show today. Like I said, it's been 17 years since you started Cleartrip, but it's been only 2 years since Flipkart took over. So can you tell us what the growth has been like since then?
Yeah, so firstly, for Cleartrip as a brand, the journey started in 2006, and Cleartrip always stood for good design language and very intuitive platform. But what it was not able to take as investment is on the tech side, on the product, or on the customer experience. So post Flipkart's acquisition, what we have been able to do is invest loads of money and manpower into amping this up with respect to tech and product bandwidth. One. Second, with respect to amping our customer experience. That's second. Third, with respect to partnerships that we have been able to build over a period of time. So all three put together, it has played a big role in us growing in the last year around 2.1x in the top line. This is approximately around 90% rise in our volumes in booking. So this is on the back of air, hotels, and buses growth. And from our point of view, we're just starting. So it's been a fabulous journey post Flipkart's investment in Cleartrip, and we've been growing phenomenally well.
So seeing a lot of growth there in air, hotels, and buses. So what's the demand been like? Which are the segments that are doing really well for you? Will we see you enter any new categories? How are you staying ahead of competition?
So if I need to broadly put it, domestic air has truly come back. The other businesses are still coming back. Maybe in the festive quarter, we'll be able to see that crossing the pre-pandemic numbers as well. So that's with respect to how the industry has shaped up. The second part of your question on the competition. So the way we look at it, and this is how the Flipkart as a group has always looked at any business that we have entered to. What's the play? What's the CVP when it comes to what the consumers want? And is the existing set of players able to offer that or not? So from our point of view, the travel has evolved. The consumer segments have evolved. Today, the consumers who are traveling are a lot more Gen Z, and the existing OTAs have not been built for that. So there are a lot more booking platforms. We believe the play is a lot more on the content, on the planning itself. So we want to go ahead in the booking journey and acquire the customers right there, rather than just playing in the booking platform. So that's one. The second differentiation we believe is that the experience that we have been able to offer to the customers is way different from any other OTA existing out there. So we launched something called Cleartrip Advantage, which offers Cleartrip Flex Max, where customers can modify or cancel their bookings in the last minute. The Cleartrip Hello, where consumers can reach our customer service in 60 seconds, or the refunds happening in 24 hours. All these might sound very intuitive, but the existing OTA players don't offer that. And that's where we believe the differentiation is going to be.
So you want to acquire customers at the booking stage itself. So what about revenues then? What are you currently clocking? What's profitability looking like? And where will the next leg of growth come from?
What I can quote is we were number 4 as per Videx report, right, 2 years back before Flipkart's acquisition. Today, in 2 years, we have grown from number 4 to number 2. And this is on the back of substantial growth, what we've been able to see in the last 18 to 24 months, right? That's point 1. Point 2, the categories which we have always been strong at are domestic air. And that's where the online penetration has been high as well. The categories where the OTAs have not been able to take a higher penetration are international air, buses, and hotels. And that's where our investments are going to be. We believe the experience needs to be completely revamped when it comes to these businesses. And that's where our investment is going to come in. With respect to profitability that you asked, the businesses like hotels and international air and buses, the profitability is much better than domestic air. So it's a combination of both where we see the opportunity and also where the margin potential exists as well. So as a combination of that, this is where we want to invest. We would grow a minimum of 60% this year on the back of 90% approximate growth last year that I spoke to you about. So that's the only number I can give you, but yes.
So like you said, domestic air has come back in a big way, but flight prices are only soaring. So talk to us about the key reasons for this. Will this trend sort of continue going forward, or will we see prices come down?
Yeah, again, I'll split domestic travel separately from international travel. So when you look at domestic, the prices, like you rightly pointed out, I think it hit very, very high numbers. This kind of segment sizes has not been seen by the industry for a long period of time. But in the last 15 days, if you look at it, the prices have already crashed by 500 to 700 rupees. We believe July, August, September is going to be one of the weak quarters when it comes to demand. So because of demand going down, and also if you look at it, the crude oil prices have also started coming down. So as a combination of both, definitely the prices would come down at least for the next 2-3 months. But this is going to be a very tactical sort of a drop, I would say, to pick up the demand again. But OND, which is a festive quarter, again, the prices are going to go up. So largely, it's a combination of both external circumstances like crude oil prices, but also with respect to internal demand that we've been able to see. But when you go to international, the situation is way too different. The prices that it has gone up by, it's like absolutely high. And not just in India, across globally, if you look at it, the prices that we are seeing now, it's easily 40 to 50% more than what it used to be pre-COVID. And that's where we believe it is going to continue as well. So we don't see any signs of prices tapering on international at all. When it comes to domestic, like I said, this quarter you would see a little bit of plateauing, but it's again going to go up next quarter.
So price of international flights not going to taper anytime soon. About 40% of the market is still offline. So how do you plan to grab a pie of this market and increase your user base? What's the online traction you're also seeing?
Yeah. So firstly, if you look at it, the penetration that you were talking about, which is like 40% offline, that's true in case of domestic air. But if you go to any other category, international air has 25% online penetration. Buses has 20% online penetration. Hotels has around 25 to 30% online penetration. So there is huge headroom for the online as a segment to grow itself. So we are in a very, very unique sort of a position, because very rarely a company would be operating in such a space where the travel itself is growing at more than 10 to 15% CAGR, right? Which is a very huge tailwind industry. Second, online penetration is again growing much faster than what the industry is growing at. Third, the company is growing faster than the channel it is playing in. So it's a combination of A, B, and C, which has led to this sort of multifold growth for us, and it's going to continue for the years to come. But if I specifically need to answer with respect to where we are going to get the growth from, buses is going to play a huge role. Today, 60% of the customers that we are seeing on buses are all new customers to the platform. They have never transacted on Cleartrip before, which means that these are new customers who are coming into Cleartrip. Second, hotels. Again, more than 50% of the customers are new customers for us. So these two categories are going to play a massive role with respect to growth and also the new customer acquisition for us.
All right, so buses will play a huge role in your growth story. All right, Ayyappan, thank you so much for joining us on the show today.
All right, with that, it's a wrap on this edition of Startup Street. It's a goodbye from Arundhati, Ritu and me, Shruti, from the Mumbai studio. Stay tuned to CNBC TV18 for more news and updates.